Hello, and thanks so much for checking out the Coin Stories podcast video page. I'm Natalie Brunell, and I am talking to the leading voices in Bitcoin. This podcast does not provide financial advice. Super excited to share this episode is brought to you in part by the Bitcoin Conference 2022. I'm so excited to be a speaker there. It's going to be held in Miami, April 6th through 9th, and it's going to be the biggest Bitcoin event in the world. All 4 days will be jam-packed with exclusive content, exciting announcements, and an incredible lineup of Bitcoin speakers, artists, and leaders. Day 1 is Industry Day for enterprising Bitcoiners who are looking to build a business or career within the ecosystem. Days 2 and 3 are General Conference Days featuring speakers like El Salvador President Nayib Bukele, who has promised a big surprise at the event, as well as CEOs like Michael Saylor, Elizabeth Stark, Jack Mallers, Adam Back, and hundreds more. The conference caps off on the 4th day with the world's first and largest Bitcoin music festival, Sound Money Fest, headlined by rapper and fellow Bitcoiner Logic. You're also going to hear from Steve Aoki, CL, Run the Jewels, Deadmau5, and many more. Last year's conference sold out, and this year's is on pace to be 3 times larger. So make sure you grab your tickets before it's too late. You can head to b.tc/conference and use the code COINSTORIES for 10% off your pass. I'm also excited to share this episode is brought to you in part by OKCoin, one of my favorite places to buy Bitcoin and dollar cost average without the crazy fees. OKCoin is the fastest growing exchange serving over 190 countries globally with the easiest onboarding and lowest fees around. They're on a mission to make learning about and buying Bitcoin easier than ever, and they're all about bringing more financial literacy to everyone, which is something I really care about as well. From being the only exchange to integrate Lightning to contributing over $1 million to Bitcoin core devs, they are doing incredible work to further the Bitcoin ecosystem. You can head to go.okcoin.com/Natalie and get $10 in Bitcoin when you sign up with my referral link. This portion of today's episode is also sponsored by SoFi. With SoFi's all-in-one platform, you can save, spend, earn, borrow, and invest. You can buy stocks and ETFs, open an automated portfolio, or my favorite part, start accumulating Bitcoin, all with no account minimums and 0 commissions on trades. Whether you're new to the world of Bitcoin or you've been dollar cost averaging or trading like a pro for years, SoFi has something for everyone. Head to SoFi.com/Natalie and sign up for a SoFi Active Invest account, and you can win up to $1,000. Super excited to share my guest today is Sven Henrich, aka NorthmanTrader, one of the best macro strategists out there and one of my favorite people to follow on Twitter. He recently revealed he is now a Bitcoin bull, a hodler, and we're so excited about this turnaround. He joined me to share his origin story, macro insights, and of course, his Bitcoin journey. Here he is. Thank you so much for joining me. I've been wanting to talk to you for so long because you're one of my favorite people on Twitter. In fact, I get notifications for your tweets because they're so funny and they're also so on point when it comes to what's happening with the economy.
Well, thanks for having me, Natalie. Enjoy being here.
Okay, so let's start from the beginning. I want to hear where you're from. I tried to do research on my guests and I couldn't find where you were born and raised. So take me back. Where are you from?
Well, I've spent a lot of time in Europe. Was originally born and raised in Germany. Spent a bunch of time in the US, but also basically all over the world. I've been basically a corporate traveler for a long time, and on that basis, you got to get flexible where you live and what you do. It's been a great experience, and these days, for many years now, been hanging out in the UK.
So, did you travel around as a kid with your family? Is it because of your parents' job?
No, I mean we traveled, of course, in Europe, but I was in the corporate world for many years, and in international corporate development in the wireless industry, and I was back in the heyday of wireless when wireless, everybody was still getting the brick phones. Basically, this was actually an interesting journey because at the time phone companies were they were not privatized; they were all government driven. And the opportunity arose for companies to then get into the telecom sector on a private basis through mobile telephone technology. And they started tendering all these licenses. And at the beginning, it was just a beauty contest, meaning you get the right partners, you get the right business plan, you apply, and whoever has the best business plan, you win the license. And then, these were huge capital investment projects, multi-billion-dollar projects. And then over time, it became, when governments realized, hey, we can actually make money with this, they started a monetary component to all this. It was a bidding process. And then all kinds of companies bid literally billions of dollars just on the licenses. So then from a corporate development perspective, we had to value these businesses, free cash flow and all that value multiples. And that's kind of where I got my knack in terms of analytical skills, because, we had to not only then value these businesses from on paper, if you will, huge Excel models, but then we also had to then build them out, and then they became, complete greenfield. And then you went into startups, and I joined a few startups and rolling them out. And then I was involved in the shareholder side. So I had the corporate perspective from a shareholder management perspective. So basically I got the whole ground up in terms of valuing businesses, understand the valuation aspects, the startup, what actually is involved, and then operating them and then managing them from a shareholder perspective. So that was quite an interesting journey for me before I got into this whole trading thing.
Well, that's all fascinating. But I mean, how did you get into that line of work? And where did you go to school and what did you study? How did you venture into that career before trading?
Well, I had an MBA, college MBA, and that's got me into the corporate side. And then ultimately, obviously, trading was a completely different journey, right? That was post corporate, and I started with nothing on that front. I had to just look at charts and get familiar with all this stuff, and then ultimately develop my own process with that. And that's a learning journey as well. So and for now, obviously, I love it. I mean, it's been my bread and butter for a number of years now. And you always learn something new. These markets are never boring.
Well, what was the year you got into trading, and why did that fascinate you, and why did you want to get into it?
Well, actually, this was not a journey of choice. Actually, I kind of slithered into it by necessity. I mean, we all have our lives, and ultimately bad things sometimes happen. In my case, my first wife died. And ultimately, then I was all of a sudden a dad with 2 young girls. And,
wow.
you cannot do your international corporate development stuff in that setting. Then my dad died. Or it was just one thing after another. And then
So sorry to hear that.
Yeah, it was a tough time, and it happens to people and families. And when that's kind of when you hit your dark side in life, and you got to learn to pick yourself up and do something else and adjust to the situation. And that's how I got started in all this. So it didn't start with here this grandiose I want to become a trader story. But as I started doing this, and I have my ups and downs like anyone else starting in trading. You if you want to survive, you got to adapt, right? And so this ultimately became a really fascinating career path. Obviously, don't have to travel internationally anymore. I can control my own time. Although these days with trading, people think, hey, instead of a 9-to-5 job, which I never had anyway, but trading now is so immersive in terms of this year is a perfect example. Last year we had these tight price ranges for hours on end, but these days, like beginning of 2022, it's absolutely insane. You cannot just sit back, and because all of a sudden you got a 100 handle rep or you got 200 handles down, you got to pay attention, and you got to keep an eye on the picture. So it's been a fascinating journey. And of course, in process of all this, by the way, being naive, starting with technicals only, obviously you quickly realized then over time that markets are not only driven by earnings and growth and what have you, but that we have this thing called central bankers who are driving a lot of this. So over the years, I guess probably deservedly so, I've gotten a bit of a reputation as a Fed critic, because I bring my macro analysis based on what I learned in the corporate view, and obviously in economics back in college and grad school. And you just look at how the world works and what the impacts are on a macro basis. And that's where I come from a critical perspective. And we always cheer when markets rip higher, but there are ramifications that I find troubling. Let's put it that way.
Yeah, well, we love your critique. And I'm shocked to hear that, the markets aren't based on actual growth and earnings. What are you talking about?
I know, it's bizarre. I mean, look what the Fed is doing, and where markets are going. I mean, big 2018 was a classic example, right?
Yeah.
We actually had earnings growth in 2018, yet markets closed red on the year. Why? Because they were tightening. 2019, we had zero earnings growth. Markets ripped 30% higher, not because earnings were growing, because the Fed was easing. 2020 was even more extreme, right? We had negative earnings growth, and markets kept making ever more new highs, right? Oh, wait, we have record earnings now, and markets are dropping. Why? Because the Fed might be tightening. I mean, it's literally that pivot, and it's become a circus because they have become ever larger in markets. Not only the Fed, but ECB and everybody else. So it's troubling.
Yeah, no, I want to dig into some of that. But first, I mean, just out of curiosity, when you say, pivoting into trading, someone who has kids, I would see that as like a really risky bet, actually, because you don't know what's going to happen, right? People could lose a lot in trading. So was there a steep learning curve, and why did you feel like ultimately that was the right decision to make? Because I'm assuming you at that point, you're on your own now. You need to take care of your family.
Oh, it's I'm not saying this was easy, and there were definitely some bombs early on. At that time it was mostly options trading, and there is a what's the most dangerous thing that can happen to a trader, a fresh trader, is that they start making a lot of money very quickly, because this is the ultimate trap, because you start feeling confident.
Yep.
And I think we've seen that with a lot of new trader this cycle around as well. You start feeling confident, and as you get confident, you think it's you. That's the genius, because the tape confirms what you're doing. And then ultimately what invariably happens is people get a little cocky, and then they start getting a bit reckless on the exposure side, right? They put more and more in, and then especially options trading can be superbly dangerous on that front. So ultimately, the transition for me was into futures, going to control a lot of things differently with stops and risk management, and obviously the 24/7 type environment that gives you that flexibility. So that was part of the journey, and then of course process. That's where my wife helped me out a lot, because she's the ultimate swing trader. And I think the most important skill that we can all have is patience. You got to wait for the setups, and I've been guilty of this myself. That this is where you learn, right? You can't chase every move. That's just soul destroying. You're gonna get ground up in the chop. Like this couple of weeks, last week, couple of weeks, great example. You pick your spots where you're going to want to get involved in on the extremes, and then on the lows you can rip this higher, but then you also got to be disciplined enough to kind of scale out. That's kind of our process, to take risk off, to close some gains. And then when the other extreme comes, then you can go the other way a bit as well. And so you have that flexibility. And if you don't, like we just saw this week, we just had another big move down, not to new lows or anything like that, but look at the action in Amazon and Facebook. I mean, just absolutely insane moves that are taking place. And so you got to be patient, and you can't be stubborn either. You can shout at the market all you want,
right?
The market doesn't care.
Yep.
Right? And what you think should happen is not necessarily what's going to happen. So you got to have that humbleness as well, to respect the larger structure and the forces that are at play. So that's kind of part of maybe a psychological mini lesson on how to look at markets and how to move through them.
Yeah, usually the opposite of what you expect happens. We all expected 100K Bitcoin by the end of last year, and boy, did we get a nice surprise. Well, anything interesting that happened, or any lessons from the booms and busts that you've experienced throughout your career, the 2000, 2008, 9, anything that's interesting that you want to share?
Well, yeah, there's a couple of key lessons. I mean, first, from the corporate perspective, corporations are not your friend. You may think you're in a social structure inside a corporation, but when the going gets tough, you're out. People may think they have job security. You don't. That is kind of out the door. And so layoffs will happen fast, and you got to be cognizant of that. So I think in general is, people just need to be aware of the circumstances that they're in, and never take anything for granted. The other thing is obviously the lesson from 2000 and 2007 was that asset bubbles build, they get ignored from the top on down. And if you're out there warning about it, you will get ignored and you will get ridiculed and da 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 da. I've had that a few times. And it is when bubbles burst, it's also not necessarily obvious. It's always obvious in hindsight, right? Mm-hmm. Oh yeah, clearly that was a bubble, right? And then I was the top. You can't call tops 2 days after they happen. They are a process. 2000 is a great example in this, because it reminds me in some ways of the current environment we're in. In 2000, we had, January, February, we had this big run, obviously, off the 98 bottom, just a ridiculous run into year end. And in 99, and then we had a correction in January, February. The NASDAQ hit pretty hard. Why? Because people were taking profits on the winners, right? That you hold off for the next tax year. That's generally what happened. And guess what happened? When people thought, oh, this was maybe it, then the dumbest rally ever happened. It was in March, end of February to March. It just ripped higher like you wouldn't believe, right? Took everyone out that was maybe trying to short this. And then it topped, then it burst. But here's the most interesting thing, that it burst on the NASDAQ, right? But the S&P and the Dow, they chopped for 6 months in a row, wide price ranges, up, down, up, down. If you were in that environment, you couldn't tell what was what, okay? Now, if you're flexible and not stubborn about things, you can take advantage of that volatility. You get oversold signals, you get divergences, boom, you can play long. You get the opposite on the other end, you can resell, right? You can navigate that through, but it's challenging. It's absolutely challenging. And then in September of that year, I believe, the S&P almost made a new high, not quite, got within a few percent of it. And that's when the recession hit, and that's when everything fell apart. So, there's often the notion that, a top happens and then you immediately know it's a top and we're going to go straight down. Absolutely not. This tops up processes. It's a negotiation. And of course, what's I think more challenging now than ever is that, because, as I mentioned earlier, central banks have gotten so tremendously large in terms of their influence on markets. This process may be even more drawn out than we've seen before. There's high stakes here. Valuations have never been higher. Mm-hmm. We've never had so much debt. We're so low on real negative rates. There's no comparison to that either. So, I hate to say it, an overused word is unprecedented, but it is unprecedented, and therefore, the lessons from history, while maybe applicable to a certain degree, in other areas, we just don't know. We're kind of uncharted territory there.
Well, Sven, let me ask you something, because we're talking about markets and, indices, but at the end of the day, we're talking about money, right? And in some cases, people's life savings. And I'm just kind of curious, because I come from Poland. My family wanted to immigrate to the United States and achieve the American dream. And it's just feels like it's getting harder and harder with the wealth inequality just ballooning and all of these issues, the asset bubble you mentioned. When you were young, did you have a sense of, I want to make money someday? Like, what, I want to be rich. Like, what's been your relationship with money as you've kind of gone through this career and seen how the whole system works, and the fact that it's pretty much built on quicksand?
By the way, I lived in Poland once for a year. That was one of those startups.
Oh, that's awesome. What city?
I was was in Warsaw. This is where we lived.
Wow.
Actually, we just lived just outside of Warsaw, but that was one of those mobile startups back in the 90s. So that company still exists over there. So that was cool. Quite fascinating. So it was very cold there, Natalie.
Yes, I know. That's why I'm in SoCal. Okay.
Hey, I hear you. I hear you. My God, it was cold. Well, look, I grew up obviously in a very different environment today. There was no internet, no nothing, and you just kind of noodled your way through it. And yes, you wanted to make money. I mean, my outlook on money obviously has dramatically evolved over the years. When you're young, you just want to kind of make money. Then ultimately you have money, and then you want to figure out how to invest. In 2000, obviously, I that bubble time, I got stung a bit as well, as probably most people did at the time. And so you learn your lessons as well, in terms of diversification and all that. But markets have changed so dramatically. The 60-40 model is out. Hedge funds are struggling left, right, and center in just catching up to the index, because everything is so concentrated. I mean, we just saw this in the last 2 days, right? Facebook down over $250 billion in market cap. And now Amazon rips up the kind of the same amount almost. I mean, $250 billion market cap moves. And that's why the index is so, tough to beat for hedge funds, because if you're diversified as they are supposed to be, everything's controlled in one index, it's going to be tough to meet the benchmark.
It's interesting because when I see your tweets, you're so tongue in cheek and sarcastic, because at this point, it's kind of all like a game in a casino, right? You have to almost make fun of it because it's gotten so ridiculous.
Well, that's the thing. I mean, I put an occasional sarcasm out there. Well, it's gotten more than occasional these days, because yes, the world has become so absurd. And it's hard not to poke fun at everything. That's why I used to obviously poke fun at Bitcoin and crypto as well, right? Because, what a time to be alive, right?
Yeah, I want to hear a little bit about your Bitcoin journey, because I know your wife had something to do with that. She was a Bitcoin bull. So when did you first hear about Bitcoin? Why were you originally very skeptical and maybe against it? And then what caused you to turn around? And if the viewers out there, the listeners, have not read your evolution post, that is an incredible read. I'm going to link it in the description, so make sure to check it out. But yeah, what's your Bitcoin journey?
Well, basically, it started with my wife chewing my ear off back in 2015, 2016. Her brother was a buyer of Bitcoin. And so, she's been charting stuff herself, and she's been trading stuff herself. And one thing I've learned over the years is that she's usually very right. And so going against my wife is worse than going against the Fed. So she has these macro charts out there. But then, when that big run happened in 2017, 20,000, she got definitely bearish on Bitcoin for a while from a charting perspective. And then she got bullish again when obviously it sold off big. My kind of separate view of all this was, and this is maybe why I was too stubborn, is just the linkage between overall liquidity into the system and what's happening on equity fronts, because everything has been completely tied together, and it is still to this day. It's quite dramatic. And so a new technology, obviously, if you look at this in context of 99, for example, there's tons of new technologies out there, there's tons of concepts out there, and they all had to kind of prove themselves, and a lot of them just got blown up. They just were not sustainable, they were not proven, and got too much leverage in the system, boom, you got the bust. But this is part of the evolution here in this last year, because I talked to Michael Saylor a couple of times last summer, and then again a couple of weeks ago, and he made a very good point, which I latched onto as well, is the fact that when we did have the bust in 2000, the companies that proved to be ultimate game changers on the technology front, Apple, Amazon, and so forth, they turned out to be the biggest winners. And yet they also had massive drawdowns, 90%, 80%. So if you bought near the 2000 tech bubble peak, you got destroyed, okay? Especially if you were over leveraged or what have you. So you had to be willing to endure that pain. But this type of pain, when a bubble blows up, is then also the opportunity to then separate, what's the phrase, the men from the boys, so to speak, right? Who's going to survive, who's not going to survive. So having mentioned that today reminds me a little bit of 2000. I come to the conclusion, okay, well, this is here to stay. There is going to be regulation, which I think is going to be important. It may be painful initially, I don't know, but it is important for clarity and uncertainty to be removed. And to the extent that we have a major drawdown like we just had, and it may or may not be over, as you and I are talking, we're back above 40,000. Thank you, because, I've been watching that technically and then started nibbling into that. Mm-hmm. But the reality is we're in a larger macro context. And, while we had an initial correction in equities, again, like 2000, we may still have a complete rip up like we did in 2000. But we're also kind of flirting with recession in a way, which seems bizarre because we just have great job numbers. We have obviously had enormous growth, but growth is slowing. Inflation is a big problem. And central banks across the globe are at least pretending to be serious about tightening. Okay, I'll leave that as a separate point. But to me, this process now of flushing out, as we've seen with SPACs, with the ARCs, innovation companies, the retail meme stocks that got absolutely obliterated. That again reminds me of kind of this 2000 scenario. And when you come out of that cycle, you will have removed a lot of the fluff, the retail enthusiasm. Basically, once everybody cries, it's the best time to buy, right? And so for me, in viewing it through that process in context of something else that's very important. Since 2009, we've all been forced into stocks. Tina, there is no alternative. And since 2009, whenever there was any hiccup, 2010, 2011, 2012, 2016, they always jump back in. So the system was never able to cleanse itself. Mm-hmm. And so we ended up with these ever more ridiculous valuations that we see, the market ever further disconnected from the size of the economy, far above what we saw even in 2000. Right. And last year, that was just an absolute mind blower. Last year alone, more money flowed into equities than in the 17 prior years combined. Everybody is long. Okay, everybody is now under this fantasy that stocks go up forever because they have gone up forever in that sense, right? Because we only had one down year in tech, that was 2018. Why? Because the Fed tightened for 3 months. That was the one time 3-month period where they were non-accommodative in their language, everything fell apart. But since then, obviously back up again. It's all central bank driven. It's created this massive asset bubble, which I view to be a risk to the economy. And with so much money tied into stocks like never before, you are clearly at risk that you're going to have a cleansing process that will take maybe years to filter through. Well, all of a sudden, and people might not believe this, but there were periods when stocks didn't go anywhere for decades, right? Yep. It's just not been that thing. And the view I have, and that's kind of my bet here, is that once that money that's all in stocks is getting dissatisfied with the returns it may be getting from stocks in the future, and I'm not talking, the next 6 months, I'm talking over like a 3, 4, 5 year period. Given what's happening on the monetary dictatorship front, if you will, in terms of devaluing currency and just basically now with an inflationary component to it, that they will seek an alternative, an alternative investment vehicle. And with basically the regulation providing that clarity, it will then give an excuse basically to come in and say, I have that uncertainty removed. I know where I can go. There's a limited supply. I can park my money there, or at least a portion of it. I'm not saying all of it, obviously, but yeah, I think it's a reasonable bet to make.
Well, I want to dig into your macro insights a little bit more, because one of the things that I've heard you say that is very compelling and very true is the pressure that this exerts on society. And we're getting more polarized and the wealth inequality is growing and it's coming out in different ways, right? And we're blaming red or blue or this or that. But at the end of the day, it seems like if you connect the dots, it's our monetary system's broken, and it allows people to privatize their gains, socialize their losses. And the average person who doesn't hold assets, their life is getting more and more difficult. So I just want to ask you, I mean, there are folks out there predicting a really big crash, right? And it's like that broken clock that's right twice a day. And others say, well, there's no way that the Fed would allow a big crash. So maybe there's a drawdown 20%, but then they would just inject liquidity and prevent it from falling further. So where do you stand on that? Because from everything that you're saying, we are too leveraged. There's too much debt. There's too much excess in the system that has to wash out at some point. And we have had the busts. So what do you see happening over the next year or couple of years?
Well, first, to your earlier point there, in terms of wealth inequality, it's been a concern of mine for quite some time. You know, to generally, obviously, we've seen political fragmentation across global Western societies, if you will. I think the U.S. is probably a lot more extreme than in Europe at this point. And I hate to see it. You know, I mean, I think just generically people want to blame social media and the influences of disinformation and this, that, the other. I think that's all part of it. But what is completely left off the public debate and consciousness is the reality of what has happened over the last 20 years. The boom and bust cycles we've had, and you know, no one can prevent a bust, and things happen. You know, it's part of the normal business cycle. But and I'll give them the credit. I'll give them the benefit of the doubt, and I'll say they did it all with the best of intentions, and that is to intervene. During the global financial crisis, they had to intervene because we were literally hours from the entire global banking system to blow up. You know, no one wants a depression. I don't want a depression, right? So they had to intervene, and they did their best. So fair enough. But if you now posted that clip as well, you know, Ben Bernanke, you know, he was in front of Congress. He was specifically asked, you know, what is your intention with the balance sheet, and you want to get back out? And yes, he said, yeah, we'll reduce the balance sheet and we'll go back to where it was just before the global financial crisis. False, you know, because right after that, the trap happened. That was the first test, and that was they ended QE1, and guess what? Stocks just dropped 22%.
Yeah.
And what did Bernanke do? He hinted at QE2, and that was it. That was the end of that. We just rallied right back up. And then they realized, and this was the other thing Bernanke said back then, and I think this is really important to understand. He said in one of the Fed minutes that rising markets will help grow confidence with consumers, who will then spend more on the economy. And all of a sudden, the link was established, meaning rising asset prices will improve the economy. What he failed to acknowledge to himself, I suppose, is the fact that asset prices are owned by the minority.
Yes.
We're now at the point where 89% of stocks are owned by the top 10%. And of course, if you filter down that further, you know, you realize that it is literally top 10%, top 1%, and top 0.1% that gather all the benefits.
Yep.
And so what happens is when you go from crisis to crisis and you always bail out the stock market, you in essence further divide, because for someone that gets caught up in a housing crisis and loses their house, the damage is lasting for years. Right? If they file bankruptcy or whatever else is happening on top of losing their jobs. If my stocks go down and I'm a billionaire, it sucks for a few weeks, right? But then they come back up and I'm okay. And they go higher each time around. So the wealth inequality is building, but the wealth inequality is just a phrase, right? There's specific consequences to that, because the wealthier get wealthier. You know, where they're going to put their money. Oh, okay, I can buy more stocks, or I can buy more real estate. I'm going to buy this house. I'm going to buy that house, and you know, I can rent it out to people, right? And all of a sudden, you get kind of a price lever in items that cost the regular folks a lot of money.
Yep.
So there's more pressure built on them to keep up with housing prices, right? And they have to lever themselves more into debt as well. So it's a broad cancer that starts building. Okay. And I think what's been happening in the last 20 years is that people feeling ever more left behind.
Yes.
And that breeds resentment. That the resentment may not have, a specific, awareness of what's going on, but it's there. And then so when you have tools like social media coming in, and you have the right voices in the sense that they know how to tap into that anger and resentment, all of a sudden you get polarity. And the polarity itself becomes an obstacle for society to actually solve problems, because there are real problems and they're complex. But if all of a sudden the political structure is incapable of agreeing where the sun rises in the morning, you cannot tackle problems if you can't agree on what the problem actually is, never mind coming to a solution for it. So I think democracy in the Western world, and in America in particular, and this is the scary part, is because of all this resentment that's built, the wealth inequality, the left behind feeling, leaves America ultimately vulnerable. Because if the solution, because for the lack of political forces to actually come to common sense solution, if the alternative is to just ask for central banks to mask over the problems with easy money, you keep propagating the problem, you keep making it worse each time around. And so you get to a cycle where there's no solution, and then ultimately central banks can't do it anymore, because all of a sudden their efficacy is completely reduced, because each time there's ever more debt, for example, and each time they can raise rates less and less, and they're forced to cut them again at a lower and lower level, then all of a sudden maybe that bailout mechanism that we now believe works every single time, maybe get to the point where it doesn't work every time. And then everyone that wanted to avoid pain over the last 20 years, then we're going to make it much, much worse, right? What if they can't stop it? That's the worry.
Yeah, I mean, everything you say is just so poignant. And this is actually one of the reasons why I ended up changing my career from journalism and wanting to educate people on Bitcoin, because ultimately you're not just educating them on Bitcoin, you're educating them on the problem that it's trying to fix. Because I think what's sad is so many people don't understand how this system works, and why having, a healthy stock market doesn't necessarily benefit the person at home watching TV and watching the ticker. And I always found it so odd that our country judges the health of the economy by how much people are spending or going into debt, as opposed to how much they're saving. That was always really backwards. And my parents, who are immigrants, they're like, this isn't a healthy economy. This doesn't mean that we're doing well as a country. We're basically exporting everywhere. We no longer make anything. We're exporting basically nothing but debt. And I just think things are so backwards now, and people are they're trying to find someone to blame. Like you mentioned, there's this feeling of angst and resentment. And I reported on it every single day as a journalist. I would interview people about poverty, homelessness, public corruption. And always it was this feeling of, I'm left behind. The system isn't fair, but yet we try to fix it with things that make it even more unfair, that allow for rent seeking, that allow for this crony sense of capitalism. And now we've gone so far that you can't pop the bubble. That would be devastating. So I mean, what do you see playing out? Do you think we'll ultimately have this devastating deflationary bust, or do you think they're going to keep printing, which is going to lead to more inflation and people will opt out with things like Bitcoin? What do you see happening?
Well, on that, I think the honest answer is, and this is probably the most frightening answer, is that nobody knows. Not the central bankers, not the politicians, not the corporations either. I think we're really in a very unique pickle here. Look, I love America, but I'm also very sad in terms of how structurally it is deficient. They keep talking about infrastructure, but I think the human infrastructure is very sad. I mean, such a rich country, so much wealth in it, and yet so much poverty and so much, just destitute out there. And it's sad. And I don't know what the answer is to that. I think, right now, you ask me about the next year or two, what they're trying, in my mind, what they're trying to do is, obviously they realized inflation got a lot hotter than they expected, right? They don't want they don't want to raise rates a lot because they can't. And I'll tell you why they can't. In 2018, the stock market, besides the Fed tightening, something really important happened. The 10-year hit 3.2%, a 30-year downward trend line from the 80s. Every time it hits that trend line, it's lights out. It was lights out in 2007, but it was much higher up, right? But it was 3.2%, hit that trend line, and then markets dropped 20% immediately into Q4, right? Mm-hmm. And the realization was, to me anyway, was the reason it stopped is because we had this incredible debt construct built that, the global financial crisis took a lot of money, right? It was deficits. We had $1 trillion deficits. And then we got to a point where, all this debt is financed with cheap money. Yeah, you can have the greatest party ever if you have just free money for everybody. Go back to the college days. Hey, free beer, free this, free that, we can have a great time. But when rates rise again, the cost of carrying that debt rises tremendously with it. So the system is so bloated and indebted that cannot, if we went back to 2007 rates to tomorrow, and 2007 rates were historically not high at all, 5%. If you went back to that tomorrow, the entire global financial system would immediately collapse. Game over, done.
All the credit would unwind, yeah.
It was just complete disaster, okay? So when the 10-year got to 3.2%, that was too much. Now, guess what we've done since 2008? We just added $8 trillion in debt. $8 trillion on top of that. So the notion, and by the way, I'm tracking a technical pattern on the 10-year. I've been tracking it since last year with this potential inverse. Beginning of the year, I just put that out again on January 4th. I think is maybe the most important chart because that technical pattern points to 3.2%. But knowing that we added $8 trillion in debt since 2018, I guarantee you that system that couldn't handle 3.2% with $8 trillion less debt can handle it this time. So there is going to be a point before where basically the Fed will have to step in again.
Yeah.
No matter what they say, okay? Because whatever they say, it never comes true anyway. They
know.
Flip-flop, okay?
It goes from the Greenspan put to the Bernanke put to the Yellen put to the Powell put. To
yeah, and the reason is math, okay? Yeah. And so if they get to the point where yields again rise to a level, and I don't know what that level will be. Right now we hit 1.9 on the 10-year today. I can imagine something in the 2 to 3, 2.5, 2.6. Yeah. If we get there, the market will let us know what that level is, and we'll start unraveling again. And then the Fed has absolutely no choice but to pivot again. It is the trap we're in, unfortunately. And that's the sad part is we're all subject to this song and dance about, they are the, I don't know, what do you call them? The arbiters or the committee that presides over everything, and they have the inside knowledge. They don't have any inside knowledge. Yeah. They're complete. Last year is a classic example. They kept talking about transitory. They're not going to raise rates until 23 or 24. Well, guess what? Now they have to do it now. So were they right? No. Did they have any special insights? No. But the market keeps giving them the credibility as if they have specific insights. In 2018, they were talking about raising rates. In 2019, well, they cut them 3 times. There's no predictability. There's no reliance on anything. Yeah, you got to change your minds when the data changes. But like for this year, people like myself were screaming all summer long last year. What are you doing? Stop printing.
Well, exactly. I mean, this isn't new information or that shocking to a lot of the people who understand this system, right? So, I mean, how does this house of cards actually stay afloat? Because you've talked about it before. The Fed has lost its credibility. I saw on Twitter someone said something that I thought was brilliant. They've turned from an arsonist into the firefighter. They're reactive at this point. So why isn't the charade up? Why does the music keep playing?
Well, they were the arsonist, and to this day they're still throwing fuel on the fire. and at some point they may want to get around to it. Look, by the way, I have a, call me a conspiracy theorist, but I've been watching this stuff so long, I can maybe have a sixth sense about all this. I wrote at the very beginning of the year, said, if they know they really can't raise rates that much, and they think maybe it's still transitory, then politically the smartest way to deal with this is to talk hawkish, ratchet up the expectations for rate hikes, let markets drop as a result, which, by the way, tightens financial conditions, which will take the pressure off of the inflation front, because yes, confidence in markets are traditionally linked, although this year and last year is bizarre because of inflation. Consumer confidence actually dropped despite rising markets. But if you do that, you can actually talk down inflation without doing anything. Okay, so now we've had a huge correction actually in the broader stock market. On the indices, it looks like a garden variety, right? We had 12.5% on the S&P, 20% in NASDAQ, 24% on the Russell. Individual stocks absolutely obliterated. Like even Facebook got obliterated yesterday. I mean, just unbelievable. And by the way, everybody had buy ratings on it, right? I mean, yeah.
And they say crypto's volatile.
Yeah. Very, very good. I think I had a tweet on that as well. Freaking big cap tech is becoming one big shitcoin complex, right? Come on. No, I mean, it speaks to instability in the system. But it's not so that it's systemic. And that was my other point in that article, to say, let markets drop a bit, but not so much that it becomes systemic. And then watch inflation come in all of a sudden below ratcheted expectations. Excuse me. And guess what? You all of a sudden you have a constructed Fed put under the market. Because now you hear the banks coming out, hey, 5, 6, 7, 8 rate hikes. Well, what if they only do 2 or 3, right? Then all of a sudden you have the put and everything can rally again and they can claim victory on inflation without actually having done anything dramatic. Look, they cannot risk a crash. They want to avoid a recession.
Especially with midterms coming. It's an election year.
That's the big thing. See, last year they were on transitory. And this is completely imaginary in my head. So let me just throw that out there. Biden called Powell in. And he says, you want to get renominated? I got midterms next year. I can't have inflation being we're going to get killed in the election if we have inflation. So get rid of inflation and do it quickly. Otherwise, you're retired. And look what happened, right? It was right around that time when Powell's nomination was kind of looking iffy. That's when he changed his tune. Completely speculative on my part, but I've seen that before with him. It was during Trump's time when the market dropped in 2018, Trump was tweeting left, right, and center at Powell, cut rates, start QE. I mean, and then he pulled him into the White House just around Christmas time. And a week later, he came out and says, never mind. We're going to stop. We're going to stop the rate hikes, and we're going to stop expanding, pulling back the balance sheet. So there's we like to think, or they like to position themselves to say that they're politically independent. Not at all. The politics are at play.
Well, I think that's a great point, actually, because this is something that I feel very passionate about. Whether the person in the White House is on the blue team or the red team, I'm sorry, but we've been going in the same direction, maintaining the quantitative easing and continuing to stimulate the economy. And people think we had the healthiest economy, in recent history under Trump. Well, no, actually, it was like pretty rotten at the core, and it has been for a decade. And now with Biden, now they want to blame Biden. Well, it's been a slow path to this, right? It's not about whether the person is Republican or Democrat in the White House.
No, I mean, all growth, all of it since 2009 has been financed by debt.
Yep.
All of it. You take all, was it, I think under Bush, it was $9 trillion in debt. before the global, or just around the global financial crisis. Now we've added $20 trillion of debt since then. Take that out of the equation. What do you have in terms of growth? Again, we do not know. We do not know what the organic or economy is. All growth last year was financed with debt. You cannot tell me that all of a sudden consumers were doing so well that they were able to spend 25% above long-term trend in the retail sales. No, it was free money. And yes, you got to help people out during the crisis. I have no problem with that. What I have a problem with that is the Fed, who for years whined about them being a lack of fiscal stimulus, so they have to carry the entire burden by themselves, while all of a sudden you have record fiscal stimulus, but they keep printing anyway. And so they're buying trillions of dollars in mortgage-backed securities into a supply-constrained housing market, and all of a sudden you're stuck with 25% increases in housing prices. And how is that helping the middle class or the poor? Was it San Francisco Bay Area, Oakland? I saw 28% increase in rental prices.
Yep.
Who's getting screwed by this? Yeah. Because these prices, and Powell admitted that actually, these, be clear about what inflation means. They're talking about year over year numbers. Okay. So when all of a sudden prices explode higher, and then they stop exploding higher and they settle in like a 2-3% range, prices are not coming back down. You're just stuck with higher prices. And if your wages haven't caught up with that, you have a net deficit. It's very problematic. So structurally, you're really hurting society in the long term. And of course, by always bailing everything out, there was a process that used to be called creative destruction. And while recessions are painful, they serve a purpose. The system cleans itself out. You get rid of the fluff, you get rid of the inefficiencies, and then new innovation comes in, and you have a better process afterwards. But by always bailing out, we never get rid of the fluff and the junk, and we just keep everything alive. And then so you get a junked out economy with lower growth. And guess what? Growth is again slowing now. Obviously with all the structural issues, the year over year comparisons, but now with this inflation. So this is going to be really tricky. And I don't know yet how this will turn out, but I'll be watching.
Yeah, me too. Well, before I start to wrap up, I have a question for you, because most of us pretty much only know the fiat standard. And in the US, I think we're very egotistical to think that we will always be the superpower. We're the reserve currency. No one can touch us. But our financial system, it feels like it's on quicksand. It's kind of one soft, blow of the house of cards and it's going to all collapse. But, just out of curiosity, because some Bitcoiners believe that the dollar will ultimately fail. Like the dollar will no longer be the king of the currencies. Do you feel that way? I mean, feel free to get, really dire and doomsday if you want, but in the future, like 10 years, what's the fate of the dollar?
Well, it's basically a relative circle around the drain, right? I mean, the issues we discussed with the US, they apply to large degrees in Europe as well. There are big political forces at play, obviously. The US has enemies, and they're not friends on a strategic basis. China and Russia is a good example. In fact, they just signed a deal on energy, and that deal is done in euros. It's not done in dollars, right? So that's kind of a, waving a flag at you. And ultimately, currency is about trust, right? And you got to be able to back it up. Now, they as long as central banks remain in control, and as long as they can demonstrate that they can remain in control, I think the status quo will kind of persist. The problem is always when the unexpected happens. I go back to 2019, actually. There was a moment when all of a sudden the Fed looked to lose control as the overnight rate spiked out of the blue. I think it was in September. They didn't know why. They had no idea why, but it caused big problems. And so they had to start this whole overnight repo operation stuff that has now morphed into, 1.6 trillion overnight type of operations. I mean, this, you ask me what it takes, this is what it takes. You have to intervene every day to have, by just exorbitant amounts, to keep the system afloat. And this is, I think, the thing we have to realize, all of us. Everything is working, everything is seemingly stable, but if we didn't have permanent intervention by central banks, everything would fall apart, because they've again made the system so dependent on them. And you tell me, if we're all believers in a free market economy and all this, how did we devolve into just judging everything through the lens of a unelected committee? I mean, this is just, I've called it the monetary North Korea. It's unbelievable. I mean, so much is really driven by these folks that can't be challenged, can't be questioned. Avoid all. I mean, I think I tweeted out yesterday, or was it with Christine Lagarde's press conference from the ECB? 440 million people in Europe, 4,500 watching, and comments are turned off. Remember those listening tours they have? I mean, come on.
I know, it's insane.
It's sad. So we all, and this is the thing, I think maybe that's the larger message. We all have no control over this. We have no influence over this. So we have to figure out for ourselves how we want to protect ourselves. I mean, housing prices go up. You own a house, that's great. Remember the housing crash. It disappeared in an instant. Stocks go up forever and at ridiculous valuations. You own stocks, that's great. Remember 2000, that can disappear all at once as well. And now compare those bubbles that had dramatic impacts on society are small compared to where we are today. So I will not pretend to be smart enough to tell you when and what is going to happen. I'm not that smart, okay? But I can just see the ingredients of this toxic blend that we have going. And I think what the lessons from the previous bubbles are very clear. People get caught up into, and this is the luring danger of bubbles, because you hear it all the time. It's different this time, right? Because it's a classic Isaac Newton bubble trap, right? And when he was with one of the bubbles that he was caught up in, he invested, he made money, he sold, he thought he was smart. Then this thing the South Sea bubble was, right? It kept going up and higher. His friends got all rich, and then he couldn't take it anymore. And then he bought into it, and then the whole thing blew up, right? What was the phrase back then? I can calculate the motion of the stars, but not the madness of people, right? And this is the problem right now, because even be it in crypto, right? You see it with 13,000 whatever currencies out there. There's all this hype, there's all this belief. You got to be in check about your psychology, what's real, because you have 100 people, 1,000 people on social media telling you a certain story. It's hard not to get influenced by it, right? It's kind of groupthink they call it, right? Mm-hmm. Just got to be careful and certainly have a vision. And that's why I like Bitcoin now. Obviously, I'm not coming here at the moment where it was FOMO'd up. I'm coming here while it's in a bear market, and I'm looking at it structurally in context of, yes, there was a lot of fluff in it, and maybe there still is. But I can look structurally from the lessons of the past, hopefully, look what's happening in the macroeconomic context and make a judgment call and say, this actually is going to be a really interesting avenue with a long-term view. I'm not doing this as a day trade or a month trade or what have you. I'm having a long-term view, and the lesson from 2000 was to have patience in that regard, which is ironically the word we started with. One of the trading lessons is patience.
Exactly. Yeah. We're so excited to have you in the Bitcoin space. So let me ask you, with regards to Bitcoin, what's maybe one feature, one thing about it that you learned? Because it takes a bit to kind of learn and really understand the network and the technology. What's one thing that makes you really, really excited and bullish? One thing. And what's one thing that is maybe your concern or something that you're going to be watching for that makes you wary of being, a maxi that puts all your money in it?
Well, the thing most exciting is obviously it is limits of supply that is not touchable by the the powers that be, if you will. Maybe naively I can compare it to our, let's say there's this limited set of Rolexes, right? If you look at it in terms of store of value, and obviously I recognize things can be fads, right? And something, remember people collecting cards and baseball cards and stuff like that. Maybe it's just a very limited people, in 20 years from now, no one cares. So that's maybe the risk in all that. But because it's a new technology that allows so much flexibility in terms of how you store it, how you protect it, and how you can transfer and interact with it ultimately, I think that's incredibly exciting. And the blockchain on which this all lies, I think it's going to be with us going forward. It's going to be playing an ever bigger part in the global financial systems, and watch central banks try to mock it up by introducing their own digital currencies. If they touch it, it dies, right? But the fact that they want to do that tells me that they're also taking it seriously. So it's not going to get banned or anything like that, because the technology will be based on the same thing. Okay. But I'd rather have that in my own private hands than a monetary North Korea, as I call it.
Yeah. But do you see a big risk or threat to Bitcoin that still makes you a little uneasy?
Well, the process I employ here is to be absolutely eyes wide open. I do see threats. I think that the correlation we have with financial assets that is currently still in play, in context of me saying, okay, there's a massive asset bubble out there, and that asset bubble could take a couple of years to implode or sort itself out. Yeah, like that 2000 example with Apple, Amazon dropping 80-90%, that could happen to Bitcoin as well. Completely eyes wide open. And by the way, I'm not calling for it. I'm saying maybe structurally it could happen. And if you use that example, 69,000, take off 90%, you back down to 7,000. Well, it's been there before, right? It's been down to 3,000, into 5,000. And that would be extremely painful for a lot of people that are new to the space or maybe too exposed. If I use it in the context of history, I said, okay, well, that happened 2000, 2001, 2002 with the Apples and Amazons, and then they can grow from there. With that long time horizon, yeah, absolutely, that could be a long-term process, and it could be painful. Regulation, right? Bubble bursting. There's these things that are still out there. On the other hand, I'm also looking at it technically. That's why I started nibbling on it in January when I saw technical confluence points. I have a specific allocation in mind for myself where I want to get to, and I'm going to use technicals to look at interesting entry points. And yeah, that's what I'm saying. If it goes lower, fine. I'm not going to be levered up. So if it all goes to zero, fine. Maybe an ego lesson, if you will, and I'll get laughed at on Twitter. Right? But that's fine. It's not going to change my life, right? But if I get to the point where I have my full allocation, and then Bitcoin goes to where I think it can go, yeah, that'll be nice. No question about that.
Yeah. Okay. Last two questions. What would you do if you were the Fed chair?
Oh God. Resign.
Yeah. Peter Schiff, he was like, I would take myself out of business. I'd shut down.
Well, the problem is what they've done to themselves now. Yeah. There's just no pretty answer at all. My work, the reason I would never be Fed chair, and no one would ever want me to be Fed chair, is because I would call it out the way it is, and would not stand there in front of a journalist and say Fed policy absolutely does not contribute to wealth inequality, which is a straight out lie. But this is what we're getting. And no, I wouldn't be for sale, meaning, I resign as Fed chair and I make millions of dollars in speaking fees by the very banks I was supposed to supervise. I mean, come on, what a banana republic setup this is. So the problem is, now that we are where we are, if I were to raise rates aggressively, we'd have a recession and millions of people get hurt. If I don't raise rates and inflation keeps creeping higher, millions of people get hurt, and we may end up with a recession. It's literally a lose-lose situation. I think there will be from that perspective, I think really careful. I think they're going to have to raise rates, and then they're going to watch very carefully. If the markets doesn't blow out on them, they may raise rates again, but they're going to have to watch the 10-year and what happens with yields. It's a terrible job, I have to say at this point, but it's terrible because of their own failings, because they are so beholden to markets, and they've proven this time and time again. And we've seen it since 2009. Every time there's a sizable correction, they blink every single time, and they've shown to the market that yes, we are afraid of the monster that we have created, right? Because now that markets have become so large vis-a-vis the size of the economy, the market actually is the biggest threat to the economy. If you see a 30% drawdown, recession guaranteed. So that did, I would never want to be Fed chairman for all that. I'd be too dangerous.
Yeah. Yeah, me neither. I agree. Well, to sort of close out, what's your message to the average person out there right now? What would you tell them to do if you could broadcast to, everyone out there who has their mortgages to worry about and grocery bills and gas at the pump, everything's going up. I mean, what do you tell the average person to do in this environment?
Well, I would say that, and I'm not one to give advice, but if you're levered, de-lever, manage your risk exposure, because you, especially now, I think maybe a lot of people started learning this lesson in the last 6 to 8 months. While the market, the indices kept making new all-time highs, a lot of people got absolutely crushed in chasing the quick rich schemes. And that applies to all asset classes. I hate to say it, even in crypto, there's a lot of bad actors out there as well. I think you got to ultimately be prepared that drawdowns happen. You got to have reserves, and we can't rely on always getting bailed out. I think that's kind of the antithesis to of a good functioning economy. Be independent. Seek out various information sources and stay level-headed, but just for God's sake, don't blow yourself up. And there's a lot of opportunities out there, and I'm loving the opportunities that are out there. And I don't want to be doom and gloom. I'm just being structurally realistic. What the heck's going on? This year, I think, is a great trading environment, both on the long and the short side. Shorting is not for most people. It's very difficult. But we have much wider price ranges this year than we did last year. The steady ascent that we had last year, that's over for now. We can still have rip-roaring rallies, but also prepare to don't get greedy. I think maybe that's the main message. Don't get greedy, stay disciplined, and just develop a process for yourself, and don't be over leveraged. So
that's great advice. It's such an honor to speak to you. Thank you for taking all this time. Anything else you want to share?
Not that I can think of. I'm, if you guys don't know me, obviously I'm at NorthmanTrader on Twitter. Sometimes I being maybe a little bit too sarcastic for my own good.
No, not at all.
I try to keep it real.
Breath of fresh air.
Yes, I'm trying to. I really appreciate you having me on, Natalie. It was a pleasure talking to you. And when we talk again.
Yeah, thank you so much. Hope to have you on soon. Thank you.